Right now, somewhere in America, a tow truck is slowly backing into a driveway before the sun even comes up. The neighborhood is quiet, the streetlights are still on, and the family inside the house has no idea what's about to happen. In a few hours, someone will walk out that front door. Maybe they're heading to work. Maybe they're trying to get the kids to school. Maybe they're already running late, and that's when they notice it. The empty spot. Their car is gone. No warning, no conversation, just a flatbed disappearing down the street with the one thing they relied on every single day. And here's the part that should make everyone stop and think. This scene isn't rare anymore. It's happening millions of times across America right now. More than 2.5 million vehicles are being repossessed, and the number keeps climbing every single month. That's the highest level since the Great Recession, when the entire financial system was collapsing. But here's the strange part. If you listen to the headlines, the economy is supposed to be doing fine. Consumer spending is up. The stock market is moving in the right direction. Unemployment numbers look stable. Every indicator the experts point to says things are holding together. So if everything is supposedly okay, why are millions of Americans suddenly losing their cars? The answer is uncomfortable. Because the car market quietly turned into a financial trap. And even more shocking, certain vehicles are far more likely to end up on a repo truck than others. 8 specific vehicles tow truck drivers see constantly. Models that look affordable when you sign the paperwork, but slowly bleed owners dry until the bank comes calling. But there are also 7 vehicles where the repo man rarely shows up. Same economy, same interest rates, completely different outcome. And once you see the pattern, you'll never look at car buying the same way again. Because the difference between those two lists isn't just about cars, it's about decisions. And the financial system is quietly pushing people toward the wrong ones. But to understand why repossessions are exploding, you first have to understand the perfect storm that created this crisis. Because 3 massive forces collided at exactly the wrong moment. The first one is borrowing costs. Over the last few years, interest rates climbed dramatically. Loans that used to carry manageable interest rates suddenly became far more expensive. And unlike the headlines suggest, those borrowing costs haven't really come down. That means millions of people are now financing cars with interest rates that would have seemed insane just a few years ago. But the second force made the situation even worse. Car prices exploded. The average new vehicle price is now hovering around $50,000. That's not luxury territory anymore. That's the average. Trucks routinely climb past $70,000. Higher trims push $80,000 or more. And dealerships didn't slow down. They just stretched the loans longer. 7-year loans became normal. Then 8-year loans appeared. Some buyers are now signing 96-month car loans. Think about that for a second. 8 years of payments on a vehicle that loses value every single day. But the third force is the one nobody talks about. Income instability. On paper, employment numbers look fine, but real life feels very different. Hours get cut, contracts disappear, gig work dries up, unexpected medical bills show up. And suddenly, the financial math that looked manageable when you signed the loan stops working. That's when the spiral begins. One missed payment, then another. Then the tow truck arrives before sunrise. And when analysts started digging into repossession data, something fascinating appeared. Certain vehicles kept showing up over and over again. Leading that list is a truck almost every American recognizes instantly, the Ford F-150. For more than 40 years, it has been the best-selling vehicle in the United States. That sounds impressive, but in the context of repossessions, it reveals something darker. Because the F-150 is also one of the most commonly repossessed vehicles in America. And the reason is simple: price. Modern pickup trucks are no longer basic work vehicles. They've become luxury machines. It's now completely normal to see an F-150 selling for $65,000 or $70,000. Higher trims easily push past $80,000, and buyers are stretching their finances just to keep up. Monthly payments can hit $1,000 or more. But the payment isn't the whole story. Insurance on a brand new truck can be brutal. Fuel costs add hundreds more every month. Maintenance and repairs stack up quickly. Suddenly, that truck isn't costing $1,000 a month. It's costing $1,500, maybe $2,000. And if anything goes wrong financially, there's almost no room to recover. What makes this even more complicated is how banks view these loans. Pickup trucks hold strong resale value, so lenders aren't scared to approve huge loans. If the borrower defaults, the bank simply repossesses the truck and sells it at auction. minimal loss, sometimes even a profit. The borrower, however, is left with damaged credit and no vehicle. And the F-150 isn't alone. The Chevy Silverado and Ram 1500 sit right beside it on repo lots across the country. Different brands, same financial pressure. But trucks are only part of the story, because there's another vehicle that repo agents joke about constantly. When workers at repossession yards talk about inventory, they often laugh about one specific car. They say the lot sometimes looks like a certified pre-owned Nissan dealership. That car is the Nissan Altima. The Altima has become one of the most repossessed sedans in America, not because it's the most expensive, and not because its owners are irresponsible, but because of how it's financed. For years, Nissan aggressively pursued buyers with damaged credit. Programs designed to give people a second chance. It sounds generous, but critics say it created a pipeline connecting financially vulnerable buyers directly to subprime lenders. Some loans carry interest rates above 20%. In one documented case, a buyer earning about $1,200 a month was approved for a payment of $445. Nearly half her income goes to paying rent or buying groceries. The math never had a chance to work, and lenders knew it, because even if the borrower fails, the car can be repossessed and resold. That system quietly produces thousands of repossessions every year, but emotional buying might be an even bigger factor. Few vehicles demonstrate that better than the Dodge Charger and Dodge Challenger. These cars are icons. Aggressive styling, thunderous engines. They turn heads the moment they appear, and that's exactly why people want them. But turning heads doesn't pay the monthly bill. Young buyers often finance these cars with extremely high interest rates. Insurance companies charge huge premiums for high-performance vehicles. Fuel costs pile up quickly. Suddenly, the total monthly cost becomes staggering. In many cases, owning a muscle car like this can cost $1,500 or more every month. For buyers chasing the image of success, the numbers don't matter until it's too late. The photos look great online. The reality looks very different when the bank takes the car back. And then there's the trap that might be the most subtle of all. The entry-level luxury illusion. Cars like the BMW 3 Series and Audi A4 promise a taste of luxury at what seems like a reasonable price. Used models sometimes appear around $30,000 or $35,000. To someone dreaming about a luxury badge, that feels like a bargain. But three hidden forces make these vehicles dangerous for buyers on tight budgets. First is depreciation. Luxury cars lose value extremely fast. The moment you drive away, the car may already be worth thousands less than what you owe. Second is financing. Buyers with average credit often face very high interest rates. Third is maintenance. Repairs on German luxury vehicles can be dramatically more expensive than those on economy cars. A repair that costs $400 on a Honda might cost $1,500 on a BMW. For buyers already stretched financially, those repair bills can be devastating. And that's how some of these cars end up back at the dealership only months after they were sold. But here's where the story takes a surprising turn. Because while some vehicles constantly appear on repo trucks, others rarely do. At the top of that list sits a car most people don't consider exciting at all: the Toyota Prius. Prius buyers usually aren't chasing attention. They're chasing efficiency, fuel savings, reliability, lower ownership costs. That combination quietly protects owners from financial disaster. Other vehicles share similar patterns: the Toyota Tacoma, the Subaru Outback, the Mazda CX-5, the Toyota RAV4 Hybrid, the Toyota Corolla Hybrid, and luxury models like the Lexus E. These vehicles attract a different kind of buyer, someone who researched before signing. Someone is thinking about years of ownership instead of a few months of attention. The vehicles themselves matter. But the mindset matters even more, because when researchers looked closely at repossession data, one pattern stood out above everything else. The biggest predictor of repossession wasn't income. It wasn't a credit score. It was why the car was purchased. Buyers chasing status often stretch their finances to the breaking point. Buyers treating cars as simple transportation stayed within safe financial limits. That psychological difference appears again and again in the data, which leads to the lesson almost nobody hears before walking into a dealership. The monthly payment is not the real cost of a car. It's the smallest piece of a much bigger equation. Insurance, fuel, maintenance, depreciation, interest, all of those numbers matter. And dealerships rarely encourage buyers to look at them closely, because their job isn't financial planning. Their job is to sell cars. And right now,